Having a well-diversified portfolio will make you money passively over time, as well as limit your risk. But here is how to pursue an even better return. What's up everyone? My name is Joris. Welcome back to my channel. Time for your weekly finance checkup. This week we will look at how to find trackers and how to pick trackers according to your investment portfolio and your strategy. First of all, if you are new to investing and you do not know how to start out building your portfolio, I would suggest watching this video right here and then come back to this one. As a start of your portfolio, you will want to have a solid base. The majority of your investment portfolio should consist of a global diversified tracker. This to make sure that your risk exposure is limited, and as a result it will provide the growth of your portfolio over time. You have to ask yourself, how much time do I want to spend on my investment portfolio? If you want to spend no time at all, that's perfectly fine. You are perfectly fine to invest your whole portfolio in one of these global allocated trackers. An example of these trackers are the VWCE or the combination of the IWDA and the EMM. If you like to follow the market news, and you are interested in new trends, you might consider looking for specific trackers and then adding them to your portfolio, of course. But now, how to find these specific trackers? First, you have to look at your macroeconomics. Oftentimes there are new revolutions in the economy. Back in the days we saw the birth of the internet, and this evolution proved to be very lucrative for newer companies in the technology sector. In recent years, we have seen evolutions in clean energy, clean water, and electric vehicles, for example. These market trends are often very popular amongst investors, and they will earn their trust quickly. If a new sector is gaining traction, it is very hard to see which individual companies will prove to beat the market and be the market leaders in the future. Most of these companies are very new and have not yet proven themselves on the market. But of course they can turn out to be the next Apple or Facebook. You could place your bets on one of these companies and you can get lucky, or you can just buy the whole market by buying the ETF. The latter obviously being the less risky choice. But still, market trends come and market trends go. It's not because electric vehicles are now the biggest thing right now, they will be popular in the next few years. You will have to keep an eye on your preferred sectors and then keep an eye on the biggest companies within these sectors, within the tracker. When a sector eventually falls out of grace, it can come down very fast. Everyone wants out at that moment, so you don't want to be there too long. This is kind of trying to time the market, something I'm very much against. But since we are talking about market trends here, and trends often run over several years, you're not really day trading, you're not really timing the market as such. You are actually making sure to adjust your investments over time and your portfolio over time according to the new current times. Also, you'll have to limit your exposure to market trends as well. Since you are allocating already a very big portion of your portfolio in that global tracker we talked about earlier, you're only invested a small part of your portfolio in these specific trends. An example here can be to invest 80% of your portfolio in the basic global fund and then the other 20% across several trends. And then you'll just have to hope to pick out the good trends for the future, of course. Finding trackers on specific sectors is not that hard. But there are some details you will have to look out for. The easiest way to find new trackers is simply by Googling them. You can find a lot of trackers on clean water by just searching water tracker or water ETF. It's very easy, right? But now you'll have to look at the following details as well. Look at the issuing company of the tracker. The most known and best fund companies are, for example, Vanguard and BlackRock. If you find trackers coming from these companies, you can be quite sure that they are compliant with all the rules and laws in your area. Then, when you find a fund to your liking, look at the assets under management. A big fund will obviously have a lot of investors and a lot of credibility behind it. Having a lot of assets under management also means that the fund can work more cost efficiently, limiting its running costs. And that is the second thing you need to look at. The running costs. Having high running costs will chip away from your yearly return. Look for trackers with low TER, so don't pay too much than you should. And after that, look at if the tracker is a synthetic or a physical tracker. A physical tracker actually invests in the underlying stocks, while a synthetic one will invest in contracts that are issued on the stocks, meaning the synthetic trackers are using leverage and they are in most cases riskier than the physical ones. I suggest sticking to the physical ones just to be safe. After that, you'll want to look at the returns of the fund, of course, and compare them to their benchmark. If it is up to par and you believe in the tracker, you can invest in it by buying it at your favorite broker. Investing in different sectors will of course expose you to new trends in the market. This way it is possible to gain more return while investing in a slightly more riskier asset. But again, please keep this part of your portfolio limited. Always make sure to have a sturdy and safe basis to start your investments on. And investing in specific trackers exposes your risk towards that specific tracker, but it limits your risk by investing in all the companies. If you've enjoyed this video, be sure to leave a like for the YouTube algorithm and to subscribe to the channel if you have not done that already. If you want to see more of my videos, you can start out by clicking one of those right here. I thank you for watching, and I will see you in the next one.